Good morning, good afternoon, good evening, traders from across the globe, and welcome to the 1033rd edition of Short-Term Trading Live with Oscar Carboni, and that would be me. Traders, welcome. Again, video 1033. There's a lot of great lessons in these videos, and there's 1,032 other ones waiting for you. Go to livewithoscar.com and take a look at these videos. Very educational, very helpful for you traders out there. All right, so this video is being filmed on Tuesday night for trading Wednesday. That's June 12th, 2013. Traders, what's on the board? The Magnetico Tapma. Do we remember that statement from early last week? Scary but true. The markets were pulling towards Otapma. Then we had the 12-day turnaround, which worked. Well, since then, things are starting to change a little, traders, and we are day traders, and I'm here to show you a red Omni for trading Wednesday. Now, we don't really clap real loud for those red Omnis, right? We'll do like this, little claps, because we don't cheer for the downside, but we are day traders. We'll take the downside if that's what they're going to offer us, right? Buy, sell, what do we care? Traders, a red arrow, why? The Magnetico Tapma is one reason, and I will show you on charts what that means. Otapma is the Omni Trading Academy's proprietary moving average, and lots of times it makes markets literally magnetic. It pulls right down to my average, so we'll see if that's what's going on. The ES, the NASDAQ, the Russell look bearish for a day trade. I'm talking for a day trade now, traders. Not for every day for the next 6 weeks of your life. A day trade, one day at a time. We're going to start the day off by selling NASDAQ S&P Tuesday night into Wednesday morning. We'll see what happens. But I'm here to say this. Do not marry any directional opinion on any trading day. Traders, this thing turns so fast lately, you cannot marry an opinion. Be even faster and more nimble with your opinions today. Loose money policy is creating massive, massive volatility. And I kid you not, the more they print money, the more we're going to get this volatility. You think about it, they're just pouring money into the system. It is absolutely going to create this volatility. You're seeing it happen. But volatility is good. We like volatility because we're day traders. The arrow goes down, the next day it goes up. Hooray for volatility. I'll take it any time over dormant markets, right? So, NQ NASDAQ bearish, at least for the onset of trading on Wednesday. We may be heading down to the Magnetico Tapma. We will talk about that in the chart segment. I want you to remember, never ever marry a directional opinion, especially the way things have been flipping lately, and know why the volatility is getting more massive, is gaining, is getting greater. Two reasons. One, the Dodd-Frank Act. The banks have decided, well, I should say the government has decided that banks aren't allowed to take our customer money and invest it in the stock market. The problem with that is the banks were the liquidity. They were there to buy and sell at every price. Where's the bid and offer? Well, the bank would go 6, bid at 7, and they would fill you at any price. That is gone. But what has happened? Traders, you want to hear something ingenious? You know what? I wasn't going to get into this, but being that I'm leading into it now, most people do not realize what the banks have done. Boy, are they smart. So, let's step back a year and a half ago. Dodd-Frank 2 years ago. Dodd-Frank Act comes down, and they say as of next year, meaning this year, you need to be using the new Dodd-Frank rules and regulations. So they basically tell banks you're not allowed to put the money in the market by trading it. No risking that money. Only certain portions of it. You need to have a lot more in your coffers than you used to have, and you're not taking those customer funds and risking them, right? Speaking of risk, we all know that futures trading is extremely risky and can cause substantial financial loss, and it's not suitable for all trading accounts, and you can lose your shirt. Just don't trade these markets if you don't know about the risk. All right, so what's going on now is this. The bank said, so we're not allowed to put money in the market, huh? Well, what should we do about this? The bank looked at all that money sitting there and said, you know, if we just leave it in the bank accounts, it gains nothing in interest. Nothing. Put $1 million in the bank right now, and what are you going to get for interest? $1,000, $500 on $1 million? It's sickening what happens now, right? So you're a bank and you're not allowed to invest the customer money. How are you going to make your customers money? Here's what they did. They said, well, let's do this. Let's go out and buy all the properties around the United States that we can buy. Now they have the property, so what they did was they took $1 million, put it in a property, and rented it out for $2,500 a month. What does that tell you? That tells you now you're getting $25,000+ a year. Who knows, maybe more on the $1 million that you had in the bank, but then invested in a property. So what the banks have done was this. They said, wow, this is working. We'll take a lot of that money, we'll buy property, we'll rent it out to people, we'll create a REIT, a real estate investment trust. And here's what they've done. They bought property. The value of property is going up, so they're making money there. They're renting out houses instead of letting money sit in bank accounts, getting zero interest, so they're making money there. They created REITs, or stock prices, in these funds they've put together, and the stock market's been going up. These nuts are making money on 3 fronts instead of leaving it in the banks. The government actually gave them a green light to go own all the property in this country without realizing that was the green light they were giving out. So now, if you trade the stock market or you trade in real estate, you're basically trading the same thing. The banks went out and scooped up all the real estate and threw it right back into the market. Tell me these guys aren't geniuses. So that's where we are now. And there are people out there saying, oh, Oscar, they're going to flood us with more foreclosures. What bank would be stupid enough at this point to flood the market with foreclosures? They have us by the kahunas, so to speak. Real estate's starting to go. Interest rates are going to start to go. People that couldn't afford to pay their mortgages and got knocked out of their mortgages last year and the year before can only afford to rent. And guess who they're renting to or from? They're renting from the banks. I mean, it's a big 360. How do you get out of their way? You cannot. So listen, if you're going to trade real estate or you're going to trade the stock market, you're almost trading the same thing. What does that tell us? There's no way the banks are going to let the real estate crack, because they're going to slowly dole out those foreclosure properties. They're not going to flood them. And Bernanke has put, I don't know, no one knows the figure, start at 8 trillion, go to 14 trillion. Bernanke has put tens of trillions of dollars of stimulus in the stock market. Do you think the Fed's just going to let that stimulus get wiped out and let the market crack? No. So the banks aren't going to let the real estate crack. The Fed is not going to let our market crack. They'll do anything to stop it. There's only one place we can go long term, and that is higher. That's my point. Do not marry any positions. Do not marry any opinions. Be a day trader, but you got to be a buyer of dips. Overall opinion, even though tomorrow we are going to start off by selling the rallies. Traders, I want to keep you focused. I know that was a lot to listen to, but it makes a lot of sense. Go back, rewind this, and listen to it. I've been doing this 31 years. I am not making this up on the fly. With no further ado, let's go look at some charts. Okay, traders, the first chart I want to show you is an old familiar chart. Do you know this chart? Of course you do. Remember I showed you the 12-day cycle, right? We didn't know how many for sure because we were counting them. As it turned out, the longest downward swoop end to back up was 12 days from top to bottom and back up. Then we had, 12, 6, 9, 9, 12. And on the 12th day, if you count these dots, we had the rally. Bingo, right? It looked great. Well, traders, here's what I dislike. After going down for 12 days, you rallied and fizzled. I don't like that. I immediately said, I don't like what I'm smelling. And we turned around today and we went short the market. And bravo, because that was the thing to do. The OMNI flipped right in the middle of the day today and got a short, and the market came off. So we know that the 12-day cycle existed and it went up for 2 days, but I don't like when the market only goes up for 2 days after coming down for 12. Comes down 12, goes up 2. What should happen next? Back down again, right? Down 12, up 2, right back down again if on the third day there's no follow-through. Well, you went down 12, you went up 1 day, you went up the second day, and on the third day there was no follow-through. That's not good. But let's look forward. I got some good stuff for you tonight, traders. Here's the E-mini S&P. Look at how long this trend line's been working for since way back before December. If you hit it, you bounce. If you hit it, you bounce. Well, here we are. We hit it. We bounced. But traders, look at this channel. We came up out of the channel for 1 day, turned around and dumped right back into it. And here is what I think the target will be for tomorrow. Let me blow up this chart. Let's get a little closer to the action here. Same exact chart blown up. You see how it stayed in this parallel channel? Well, it got out of it for a day. That was on Monday. Tuesday, we fell back into it, traders. I say at least here now. At least here. You had 2 days up in what's turning into a bearish month, let's call it, right? A bearish half a month at least. And you had 2 days up. I say you sell after the second day up. and that is exactly what we're going to do on Wednesday. Then you look at the NASDAQ traders. You got the same thing going on. The NASDAQ looked great. It was in here. It popped out for one day, came back down yesterday, which would be Tuesday, and settled all the way down here, back inside of that parallel channel. Here is your target now, traders. That's what we're looking for, maybe as early as tomorrow. Then you take the Dow Jones Industrial Average. Look at how long it stayed inside of this. I mean, come on. It gets out underneath, right? Goes back up and gives us some hope. But look what happened on Tuesday. Now you're back under that major trend line again. I don't like that either. As you can see, traders, I don't like what I'm seeing here. Blow that chart up. Let's get a little closer to that very same chart, Dow Jones Industrial Average, and you'll see you pulled the same thing. You got out for a day, came right back down, settled under it, and your target is now lower. That's for day trading in the S&P, NASDAQ, Dow. Then there's the DAX, traders. The German DAX has done exactly the same thing. There are two channels here. Here's your primary channel and your secondary channel. So the outside lines are your secondaries. Here's your primary, right? The primary channel, the market stayed in, hit the top, bottom, top, bottom, top, bottom, gets out, hits the top of the secondary channel, comes right back down and gets into the primary channel. That means we're coming to the bottom of it minimum, maybe even to the bottom of the secondary channel. DAX agreeing with NASDAQ and S&P's assessment for trading on Wednesday. Then there are other markets like the euro. How goes the euro lately? How goes opposite the ES? Or, let me say, how goes the US dollar? How goes the ES? They both seem to go together. So, here is a euro chart. This is a bull flag inside of a parallel channel. Big red parallel channel. This is a bull flag right here. Traders, if you have a bull flag inside of a parallel channel and you're breaking out above previous highs, what does that tell you? Obviously, it tells you it's a buy. Now, if euro looks bullish, and there's a lot of news coming out of Europe tomorrow, out of Germany, so you never know what's going to happen there. But if euro looks bullish, it makes dollars look bearish, and if dollars look bearish for tomorrow, that would make my ES scenario sound likely. So here we are, comparing one market to another. Then you got a market like gold, traders. Gold, as I have stated to my OMNIacs many times lately, gold has become a market in a world of its own. It doesn't care anymore where the S&P goes. It doesn't care what we do with the stocks. Gold needs to continue to come off. We are sellers of rallies in gold, even though you may get a little bit of upward action at the beginning of Wednesday's trading because the S&P is looking weak. But overall, you will find willing sellers in the gold if it rallies. Traders, look at how well gold has worked on one of our key averages. It could not get above it here, it could not get above it here, and it could not get above it once again just 3 days ago. So this tells me our bigger picture scenario about gold is correct, and gold will head down big picture. This is not for day trading tomorrow. This is the big picture. Probably for tomorrow, you'll start on your way up and then turn around and watch it dump. But I would say for a longer term, you look at a big bear flag like that, failing at an average, and you'd expect downside. Then, of course, you can look at this as a head and shoulders building. There's a lot going on to be bearish gold. Traders, there's more. Now we look at bonds, and I'm here to say what I think is going on. S&P's coming off this week. Next week, we have a Fed meeting, right? Here's what I say happens. Bonds, interesting chart we're going to go over in a moment. S&P comes off the next few days, then turns around and starts to stabilize right before next week's meeting. Bonds will probably rally a little, stay inside the flag right up until next week's meeting. And when the Fed speaks, the bonds continue to crack and the S&P turns and rallies. But that's next week. I'm just telling you my 8 to 10 day scenario. So you look at bonds, you got a big, big left shoulder, a big head, and a big right shoulder. So here's your head and shoulders formation. In the left shoulder, a bull flag forms and fails to work, which makes perfect sense if it's a left shoulder because you're supposed to go up from there. We come back down and create another bear flag, but this one right here should work. Why? Because now it's a bear flag in the right shoulder. That should be the death knell, as I've been telling you for weeks now, that the top in bonds is in. Bonds are done. And here's another one of the reasons. A big bear flag inside of the right shoulder of a head and shoulders, a bearish head and shoulders. And I think that if the market rallies a little bit, it stays inside of these blue lines till the Fed comes out with their decision next week, and down we go. Traders, that is my scenario. This is for next week, although you may get a little bit of a rally this week. That's for slightly longer term. Everything else I showed you is for trading for Wednesday and maybe Thursday this week. So, traders, you've seen the charts. There is my technical argument for why we're starting this day off with a red Omni. Traders, remember, do not marry a directional opinion throughout the day anymore. You can't even be bullish or bearish for an entire day anymore. Start the day off with your opinion, let it happen, and then step back and see what comes next. Because the grand volatility that we've been seeing lately makes it where anybody's system is going to start flipping constantly, and it's going to think it should be reversing to long and reversing to short. That's called expanded volatility. You need to stay focused and recognize that we are in a major bull market having some pullback. Remember that scenario about the bonds? I truly think that that's nothing more than a play. It is a play till the Fed meeting next week. That's what I think is going on. Nothing more than nonsense. These boys seem to know how to play this thing. Suddenly bonds are going to become bullish. Suddenly gold might pop a little bit. Meeting next week, the S&P gets bearish for no reason. All sounds to me like next week we'll be unraveling this mess. But we are day traders. We'll take it one day at a time. Traders, come on down to livewithoscar.com. Come hang out with me. We got a long way to go. It's only Tuesday night. You got Wednesday night, Thursday night, then the insanity of Friday. So make sure you are with me at livewithoscar.com. And traders, nobody won a t-shirt today. I'm going to clap for that. I didn't have to mail anything today. Hooray for Oscar saving money on postage. Hey, we did a t-shirt contest today, and not one of you came close to calling where the S&P was going to close. How tricky of these markets have they been lately? I've got guys at 3:30. I go 3:30 in the afternoon. The close is 4:15. I go, okay, whoever can call the S&P close wins an Omni t-shirt. Well, nobody even got close. That's how much we move lately from 3:30 till 4:15. Imagine that. No shirt winner. Come on down to livewithoscar.com tomorrow and make sure one of you win a shirt. I'll see you then, traders. Always keep your emotions out of trading. One of the best things you can do to help yourselves is say this to yourselves every morning, every afternoon, every evening, and you know what that is. Stops are in. Emotions are out. Rock and roll. And boy, emotions better be far away from this thing this week. Traders video 1033. Watch out for expanded volatility.
Traders, Oscar Carboni is holding another Omni Camp live in Las Vegas. Omni Camp is an intensive 4-day course taught by the Wall Street whiz Oscar Carboni himself. Oscar has been analyzing markets and trading commodities on and off the New York trading pits for over 30 years. Trading for a living is a very difficult business. Oscar will simplify the process so that you can easily understand and analyze the markets. Classes are limited. For more information, call 702-629-4755. Our phones are staffed 24/7. Futures trading is risky and can cause substantial financial loss. Trading futures is not suitable for all accounts.
Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided.